We heard from the Bank of Canada governor today. We also heard from U.S. Fed Chair Jerome Powell. He also spoke about the challenge of the trade war as he tries to balance controlling inflation and boosting slowing growth. For more on that, let's go to Ella Hoxha, head of fixed income at Newtown Investment Management. Ella, thanks for joining us today.
Pleasure. Thanks for having us.
So the Fed needs clarity, he says, on the impact of tariffs, which everybody is looking for, and he wants that before making any moves on the rate. But do you think he's going to get it?
Well, actually, clarity is probably the luxury all of us would love to afford right now. But it's a very complicated situation. It's without a proper historical precedent. So it's very difficult to compare, particularly in a world where all supply chains are integrated. And so it's very hard to have a lot of prediction power here. And so clarity, I think, won't be forthcoming anytime soon.
Okay, so if he doesn't get any clarity and doesn't have any data that will give him that, do you expect a continued hold from the Fed chair?
Yes, I mean, certainly we heard as much this evening, or well, my evening, at least your afternoon. And certainly it looks like they need to see more data points, more evidence, which probably means that the Fed is likely to be reactionary, so less proactive in this case, which certainly increases the risks for both the economy, but also financial markets. And you can see that in the way that equities reacted today, and also bonds actually rallied on the back of that. So it's confirming the view that perhaps the Fed is not being as easy as it might need to be under the circumstances.
March retail sales in the U.S. were up. They climbed pretty high, highest they've been in 2 years. But they think it's because Americans are rushing, right, to buy cars and other bigger ticket items before tariffs kick in and make them costlier. Are they essentially pulling sales that would have happened later in the year, so we can expect then lower numbers for the rest of the year?
And look, the U.S. consumers held up pretty well so far. It's kind of depleted its savings some time ago. So the logical conclusion here is that the consumer in the future will be at least somewhat weaker. But it's also logical to conclude that they might be front-loading some of those purchases. I mean, we all would, right, if we thought prices are going to get higher, let's say, over the course of the next several months, then it's natural to bring those purchases forward. So I think that is an easy conclusion to make. We just won't know in what shape they will be. But certainly, given where their inflation expectations are in terms of the measures of consumer surveys, where business sentiment is as well, it is natural to conclude that perhaps you're looking at a weaker consumer backdrop in the future.
U.S. consumer sentiment, as you know, also low at a 3-year low. Consumer spending accounts for a big part of the U.S. GDP. So what does that mean looking forward?
I mean, look, like all the pieces in the puzzle that we discuss, we're going to find out as we move along, right? I think, again, as I said earlier, it's very difficult to have a proper roadmap here. Markets will shoot first and ask questions later. So at this juncture, we're still not pricing the outcome of a potential recession, let's say. So a weakening in consumer from here certainly will be, quite a bit of a trigger, particularly for equities to potentially trade lower. And we're seeing that today. So very difficult to read too much into today's data. But forward-looking, you can look at a possibility of a weak consumer, potentially weaker earnings growth. And we're starting to see that in some of our more sort of leading indicators that we utilize in-house.
So, Ella, we also saw some of the bigger banks reporting in the U.S., and they're doing well. I'm wondering when the full impact of the tariffs kick in, what your expectation will be for corporate earnings, so be it, Q2 or further on in Q3.
Well, it all depends on whether we actually get a recession. And so in-house, we're thinking probabilities of that have certainly gone higher. And, you can certainly argue they're above 50% here. And so if you're looking at that kind of backdrop, you're looking at price to earnings for equities, say, on a 16 multiple to make them attractive for investors. And so I don't know, earnings growth starts to drop to single digits. So let's say anything in the range of 6 to 8% is possible, but you could get even weaker earnings growth. And that's kind of like the setup that we're looking for. And the key point to make here from a financial markets perspective is that we haven't priced that yet. It's not priced in equities, it's not priced in bonds. And so I think we have more ways to go here. So I think we are in that environment. Nothing's going to be clear fully on tariffs over the coming weeks. But what we could get on the positive side is potentially engagement with trading partners and perhaps some green shots to come out of that. So, it doesn't have to all be, gloomy. There could be some positive developments as well. So we'll see how that engagement works and whether there's further retaliatory measures and so on and so forth. But as things stand, we are looking at a somewhat of a weaker backdrop here for markets.
All right. Ella Hoxha is head of fixed income at Newtown Investment Management. Thanks for joining us today.